Hello everyone, welcome to the 113th episode of me learning how to trade in Forex. So in the last episode we went through the trade retrospective. Basically, being retrospective means to take a look back at the events that happened. Once you finish trading, it's crucial to review how your trade went, whether you'll win or lose. You want to look back at the whole process to understand what you did right and wrong. And then we went through some questions to ask to yourself regarding the trade you just done. So how well did your trade work out? Was the position size sufficient to match the risk and reward scenarios, or was it too large, too small? Could you have entered at a better level? What tools might have you used to improve your entry timing? Were you patient enough, or did you rush in thinking you'd never have a chance again? Was your take profit realistic or a pie in the sky? Did the market pay any respect to your choice of take profit levels, such as stopping short of it, or did prices blow right through it? Did the market pay any respect to your choice of stop loss levels, such as stopping short of it, or did price blow right through it again? What news or event catalyst caused the market to move the way it did? And then you can use the answers which you've written down to refine your position size, entry level, and order placement going forwards. And then we've also had some questions about how well did you manage the trade after it was opened. So were you able to effectively monitor the market while your trade was active? If so, how? If not, why not? Did you modify your trade plan along the way? Did you adjust your stop loss order to protect profits? Did you take partial profits at all? Did you close out your trade based on your trading plan, or did the market surprise you somehow? So based on them answers, you'll learn what role your emotion may have played and how much of a disciplined trader you are. What can you improve and what specific steps will you take for improvement? So how will you hold your winners longer? Will you work on choosing a better profit target? Will you learn how to not freak out at the first sight of your unrealized profit falling? You've got to be honest with the answers. And did you execute your trade according to your trade plan, which is the most important question because it shows how disciplined you are. Right. And if you're not disciplined, then you need to fix yourself so that you become disciplined. There we go. And now we're on to trading performance statistics. So, trading performance statistics. 22/04/2024. So, while your bottom line, total profit or loss, can easily tell you your overall trading performance, keeping statistics is a great way to find out what parts of your trading system are keeping you from running like a finely tuned race car instead of a junkyard clunker. My inspiration for my trading system. Your performance stats help you determine what's working, what's not working, and what to improve on. Here are some of the statistics to keep at a minimum to track your system vitals. Your performance stats help you decide what's working, what's not working, and what to improve on. Here are some statistics to keep at a minimum, track your system vitals. Right, okay, so minimum stats to record. Net profit. Your net profit is your total. Well, let's just make this on a new line actually. So net profit. Your net profit is your total gain minus losses and expenses. Total gain minus losses and expenses. These expenses include the cost of equipment, commissions, and other costs. Basically, this is how much your account is up or down at any given time minus the cost to trade. So this is how much your account is up or down at any given time minus costs to trade. Win percentage. Win percentage is the total number of wins divided by the total number of trades. Total number of wins divided by the total number of trades. What percentage of time do you win trades? Loss percentage. Total number of losses divided by total number of trades. Total number of losses divided by the total number of trades. What percentage of time do you lose trades? Largest winning trade. Your largest winning trade will be removed from your average win calculation. This will be taken out of your average win calculation. So this is like a basically like an outlier. So our average win, I'm assuming, is going to be like an average, and we don't want to have an outlier just messing up the average, because it'll probably push it upwards if it's really big compared to your average numbers. So this is not necessarily to do, but if you do have an abnormally large win in relation to your other wins, then taking it out will provide a more accurate look at and expectations to your stats. Largest losing trade. This will be taken out of your average loss calculation. So your largest losing trade will be removed from your average loss calculation. This is not necessarily to do, but if you have an abnormally large loss in relation to your other losses, then taking out will provide a more accurate look and expectations to your stats. Average winning trade. So the average gain per winning trade. Average gain per winning trade. Let's call it that. Computed by dividing the total gain from all your winning trades. What? Dividing the total gain from all your win divided by the number of winning trades. Computed by using your total profit, let's just say that, from all your winning trades divided by the total number of winning trades. Average loss per losing trade, computed by using your total loss from all your losing trades divided by the total number of losing trades. Right? Average loss per losing trade is your total loss from all your losing trades divided by the total number of losing trades. Yep. Payoff ratio per trade. Payoff ratio, let's just scroll down a bit, per trade. The payoff ratio per trade is your average winning trade minus your average losing trade. Right, so average gain per winning trade divided by minus average loss per losing trade. There should be a ratio though, so surely it should be something against something, not just a number. Per trade. Per trade. Right, okay. Average holding times per trade. The average holding time per trade is calculated by dividing your total holding time computed by dividing your total holding time for all your trades by the number of trades. Computed by dividing a total trading time, total holding time for all your trades by the number of trades. Profit loss of long trades versus profit loss of short trades. PL of long trades versus PL of short trades. This stat help determines what types of trade or trading environments you perform well in. Determines what type of trades or trading environments you perform well in. Largest number of consecutive losses. Largest number of consecutive losses. This stats helps you in determining your max drawdown or the worst possible scenario you've experienced so far. Helps to determine your maxed drawdown or the worst possible scenario you have experienced so far. Average number of consecutive losses. This stat helps you in determining your average drawdown and controlling your potential max risk. Helps to determine your average drawdown and controlling your potential max risk. Your average drawdown and controlling your potential max risk. Maximum drawdown. The maximum drawdown is the worst period of peak to valley performance of your trading system. The worst period of peak to valley performance of your trading system. Trading expectancy. In simple terms, expectancy is the average amount you can expect to win or lose per trade. Expectancy is the average amount you can expect to win or lose per trade. This can be computed by multiplying the loss percentage by the average loss and subtracting it from the win percentage times the average win. This stat helps you determine the correct position size and how profitable your trading method is. Why don't they just write it in a formula instead of writing sentences? This can be computed by multiplying the loss percentage. So computed by multiplying the loss percentage by the average loss so this is basically by multiplying the win percentage by the average win minus multiplying the loss percentage by the average loss. This stat helps you determine the correct position size. This stat helps you to determine the correct position size and how profitable your trading method is. Tracking feelings and mistakes. Your mental state can't exactly be tracked as a statistic, but you should record it nonetheless. Record your mental feelings. Keeping track of how you feel will help you avoid trading during these frustrating times, like when you wake up right after a news event that you forgot about and it pushes the market fast, so you try to chase it. But then your computer crashes, you lose power, and your dog goes running out of the house and onto the oncoming traffic. By the time you get back online, you see the market has moved 100 pips in the direction you wanted to buy. Don't you hate it when that happens? You're probably not in a good mood by then, so trading for the rest of the day may be a bad idea. Ideally, you should be keeping track of these statistics so that you can compare and analyze your performance over a set period of time. Your mental feelings, including the situations which led to those feelings, I guess, as well. Ideally, you should be keeping a track of these statistics so that you can compare and analyze performance over a set period of time. For example, at the end of the year, Huck releases her year-end trading review. After going through her trades, she could see that she was actually unknowingly taking trades against the trend. Knowing this, she can adjust her trading so that she can avoid going against the trend, and this will hopefully lead to better trading performance. The goal of collecting and calculating these stats should be to find ways to maximize your expectancy, pips or dollars gained per trade, set the correct position size per trade, and determine the trading conditions best suited to you, for you. So use these stats to maximize your expectancy, set the correct position size per trade, and determine the trading conditions best suited for you. Oh no. Okay, reviewing your trading journal. So, after a good number of trades, you will have collected a lot of fancy schmancy data and observations on the market and yourself. How do you analyze it all? It's pretty simple. Find what works and keep doing it, find out what doesn't work and stop doing it. And finding what works and doesn't work is all about keen observation and asking the right questions. Refine your analysis of your trading results by breaking them down to smaller categories, such as day of the week or specific currency pairs. Here's a sample of the types of questions you should be asking yourself when you're reviewing your journal. Questions you should be asking yourself when you're reviewing your trading journal. So, which chart patterns or technical indicators work best for you? Which do not? Which chart patterns or technical indicators work best for you? Which chart patterns or technical indicators work best for you? Which do not? How can you adjust your indicators to get you in trades earlier or help you avoid whipsaws and fake outs? How can you adjust your indicators to get you in trades earlier and help you avoid fake outs? Are you closing winning trades too early? Is it that you need to adjust your profit targets, or are you afraid of losing your unrealized gains? Oh. Is it that you need to adjust your profit targets, or are you afraid of losing your unrealized gains? Wait, so what if you're actually afraid of losing your unrealized gains? Like, how would you... I guess you could just... You can't, like, be thinking about it then, basically. So... you can't be thinking that, oh, I'm going to lose all this. You just have to trust in yourself and say that, oh, I believe my own judgment and that it's going to make it till the take profit target, basically. So maybe that. Do you hold on to losing trades longer than you should? Hold on to losing trades longer than you should. How can you improve your stop loss process? How can you improve your stop loss process? How often do you follow your trading plans? How often do you follow your trading plans? How often do you follow your trading plans? Of the ones you do follow, have you been profitable? Of the ones you do follow, have you been profitable? What trade setups did you miss or not take, and why? What trade setups did you miss or not take, and why? Was it a legitimate signal or setup according to my method or system? Was it a legitimate signal or setup according to my method or system? Was it a legit signal or setup according to my system? What could you have done differently to prevent, reduce this loss, or maximize your gain? What could... well, why is it doing that? What could you have done differently to prevent, reduce losses and maximize your gains? Are you winning more on trades with multiple lots or single lots? You're winning more on trades with multiple lots, or single lots? What kind of market environment have you been doing well in, trending or ranging? Market environment have you been doing well in, trending or ranging? I think that depends on your trading method, doesn't it? Or trading system. Whether you're trying to trade in range or trade in trend. Were most of your wins or losses biased towards certain currency pairs? Most of your wins or losses biased towards certain currency pairs. Which news events have brought on the kind of volatility you are looking to trade or avoid? Which news event have brought on the kind of volatility you were looking to trade or avoid? Which trading session have been the most favorable to your trading style? Which trading session have been the most favorable to your trading style? So is that like for example the Asian trading session, the European trading session, like that sort of thing? Are you losing trades concentrated on certain days of the week, such as Mondays and Fridays? Are you losing trades concentrated on certain days of the week, such as Mondays or Fridays? Questions like these can help you quickly filter out the actions that have kept you from making some pips. In the beginning, the idea is to get to the point where you have figured out what works for you and only do those things. Once you've figured out those right things, the next step is consistently practice those actions that work until it becomes a habit. Finally, persistent journaling will help keep you on top of your performance and help you recognize when the markets change. And yes, the markets are always changing. Figuring out and consistently. So in the beginning, these questions help you figure out what works and what doesn't work. Once you've figured out what does work, once you've figured out what does work, only do those things. Then consistently practice those things so that it becomes a habit. Persistent journaling helps you to keep on top of your performance. and help you recognize when the markets change. And help you recognize when the markets change. Right, so keeping a trading journal is hard, but it's worth it. Keeping a trading journal is hard, but it's worth it. Keeping a trading journal is hard, but so is losing all your trading capital, failing as Forex trader, giving up, never to return to Forex trading ever again, and reminiscing about the good old simpler days of being happy when there are only 5 TV channels to choose from. Which would you rather choose? Entering trades in a journal forces you to view the trades in black and white rather than simply relying on your memory, which for most humans is a stretch. More importantly, a trading journal allows a trader to step back and view their trades as a group of trades, and not as individual and ultimately random transactions. Boy, this sounds a lot like work, doesn't it? Heck yeah it is, but doesn't anything worth achieving require work? True. Keeping a trading journal is equivalent of an athlete's practice. It's not uncommon for a professional athlete to spend far more time practicing or training for an event than actually participating in it. According to Tim Grover, Michael Jordan's personal physical trainer, Michael would go for 40 or 50 points one night, and then the next morning he was right back at it in practice. He just couldn't take a day off. His mental toughness was unbelievable. But the reason was that he was so physically ready every day. He used to have a saying, "I practice so hard because that makes the games easy for me." I practice so hard because that makes the games easy for me. John Wooden, winner of a record 10 NCAA men's basketball championships, and known as one of the greatest minds basketball has ever known, ran a very strict and disciplined 2-hour practice 5 days a week in preparation for a 40-minute basketball game. Do you know how much time that is? Do you know how much time that is? That's 10 hours or 600 minutes of practice for 40 minutes of the real thing. Practice makes perfect, true. And that's not all. Not only did he stress meticulous and deliberate practice, but he also kept a log of how every practice went. Coach Wooden would refer to his practice logs if his team had a problem he couldn't solve. For example, if his current team was shooting poorly, he would research his old practice logs to determine how they could improve their shooting. Even in days of no computers or iPads, Coach Wooden understood the importance of strict record keeping. While the act of journaling really isn't that hard, it is a time-intensive process that will require consistent effort. Effort you never know unless you try. True. So a trading journal allows you to step back and view your trades as a group of trades. Yep. Summary: keeping a trading journal. Summary: keeping a trade. What is going on? Keeping a trade journal. So, your trade journal is a log of all trading activity. Your trade journal is a log of all trading activity. A trading journal provides any serious trader who wishes to make money a tool to help them evaluate themselves objectively. There are 3 elements for sustained successful trading. 3 elements of, for sustained successful trading. Having and executing a good trading plan. Executing a good trading plan. Having a good trading system as part of that plan. As part of that plan. Review and improve your trading performance and plans. Every Forex trader should maintain a journal that focuses on these elements. This journal's objective is to monitor both the performance of your trading system and your ability to execute it with consistency. Your trade journal's objective is to monitor both the performance of your trading system and your ability to execute it with consistency. Poor trading systems are less frequently the cause of poor trading performance than the inability of the trader to properly follow the rules of the trading system. Well, let me just reread that again. Poor trading systems are less frequently the cause of poor trading performance than the inability of the trader to properly follow the rules of the trading system. That's following the trading plan. Your trading journal is intended to make sure you do that. Journals are only as good as what is written in them. If one fails to accurately track trades, it becomes hard to judge trading performance. This should be ongoing efforts, not just a one-off for the sake of completing an assignment. Be thorough and honest. Filling out the trade journal should be ongoing and not just one-off. Be thorough and honest in your trade journal. Do not shortchange yourself by failing to put in entries through incompleteness. Be thorough and honest. Do not shortchange yourself by failing to put in entries or through completeness. Learning to write and maintain a trade journal will build your discipline in you. No excuses. Not only that, when you reflect on your entries after a month of trading, we guarantee you will learn a lot about yourself and your trading psychology. You clearly see what you're good at, what you suck at, and what's the best way it is for you to trade. This is something that no mentor, no video, no seminar can teach you. You have to experience it yourself. Only through this experience will you become a successful trader. To build the skill of trading, you must have the will to maintain a trading journal. Always keep a record of each of your trades, with details of why you got in, how you got out, and why it turned out the way it did. Here are some final advice for keeping a helpful trading journal. Always begin the journal before the trade and end it after the trade. Always begin the journal before the trade and end it after the trade. Write down everything. Don't leave anything out. Be honest. If you decided to play Call of Duty while you're on a trade and forgot to exit your trade, write that down and explain why. Pay very close attention to your emotions, then make sure you write them down. Pay close attention to your emotions and write them down. Make sure the journal includes observations about you and your trading and about the Forex market. We found that trading journals are usually skewed towards self-analysis and include little in the way of market observation. And your trading and about the Forex market. Make sure the journal includes observations about you, your trading, and also about the Forex market. So could that be like on what you think is happening in the markets, basically? Like your view of the market. We found that trading journals are usually skewed towards self-analysis, include little in the way of the market observation. So write down what you think is happening in the markets. Take a screenshot of the intraday charts of each day's action and write comments on them. Take screenshots of intraday charts of each day's action and write comments on them. And write comments regarding them. Make note of patterns that you are watching. So for example, you take a screenshot and then you write down, oh, I see a candlestick pattern that shows a sign of reversal. Therefore, I think to myself, oh, because the previous trend is an uptrend and the reversal candlestick pattern shows up, I think it's going to go into a downtrend soon. And then I think that's what you write on the screenshot. That sort of thing. After a couple of months, you start to see the patterns emerging in real time. A trading journal is a learning tool and a great mechanism for training your eye to see the setups you want to be trading. Nothing's too silly to record inside your journal. Write it down. Write down whether you missed a trade because you were watching the latest episode of The Crown or playing Call of Duty, or you were busy talking to your sweetheart. Write it all down. Leave nothing out. Quiz time. Keeping a trading journal. The notebook. Put your thinking caps on, boys and girls. It's time to test your knowledge on how to properly journal your trades. Why is keeping a trading journal important? It guides you in improving, helps you keep track of both. Keeping a trading journal helps keep track of one's performance and guides you in improving your performance. True or false? Keeping a trading journal is the same as copying the transaction history on your account. False. A Forex trading journal isn't just about writing in the prices of your entry and exit and the time you executed the trade. The trading journal is also about refining your methods and mastering your own psychology. What differentiates a trading journal from your transaction history? The former includes your psychology before, after and during the trade. The latter includes your psychology before and after during the trade. It's the former. A trading journal is about your individual emotion psychology before, during and after the trade. True or false? A well-kept detailed trading journal can be as good as having a coach or mentor guiding you in trading. True. A well-kept detailed Forex trading journal can be almost as good as having a coach watching you over your shoulder and helping you learn those lessons. Heck, keeping a journal may seem boring or time-consuming, but a Forex trader can often learn more from reviewing their own trades than from reading a book or even attending a seminar. Which among these should be included in your trading journal? Market views and philosophy, market observations, performance statistics, all of the above. Market views and philosophy, market observations and performance statistics should all be included in your trading journal. Why should you record your trading mistakes and missed opportunities? To avoid making the same mistakes in the future, to be hard on yourself, to make your journal interesting, to avoid making the same mistakes in the future. Closing trades too early, not taking legit setups, entering the wrong entry levels, or position sizes, etc. should be recorded in your journal so that you avoid the same mistakes in the future. Which among these is not part of our top 5 elements of a trading journal? Entry trigger, position size, trade retrospective, none of the above. None of the above. Our top 5 must-have elements of a Forex trading journal: 1 potential trading area, 2 entry trigger, 3 position size, 4 trade management rules, and 5 trade retrospective. Your potential trading area stands between the current price and your entry trigger. Your potential trading area stands between the current price and your entry trigger. What is another term for a setup that lines up with your specific entry technique and makes sure that it's safe to enter the market? High probability setup. A high probability trade setup is another term for a setup that lines up with your specific entry technique and makes sure that it is safe to enter the market. True or false, using an entry technique is a standalone strategy without potential trading areas the recipe for success. False. Don't forget that you must combine a good entry trigger with a good potential trade area. A moving average crossover may be a popular entry technique, but if you don't factor in the area in which you're thinking of entering, you'll probably be whipsawed to death. What should you figure out before you enter a trade? Potential scenarios and market reactions, how to spend your winnings, how to make up your losses. The first one. When you enter a trade, you should have already decided how you will react to every possible outcome. What does trade retrospective refer to? Looking back at the trade to recall what you did right or wrong. Yep. Retrospective means to take a look back at the events that already have taken place. You want to look back over the whole process to understand what you did right and wrong. True or false, it's okay if you're not routinely executing your trades according to plan. False. If you're not routinely executing trades according to your trading plan, then you either have a serious problem with self-discipline or there is a problem with your trading plan. Which among these should not be included in the performance statistics? What you plan to buy with your profits. Correct. Once you've finished trading, it might be tempting to call up your homies to hit up happy hour, kick back shots of Patron and splurge on bottles of Dom Perignon, but it's crucial that you review how your trade went, win or lose. True or false, keeping a trading journal is hard. True. Keeping a trading journal is hard, but so is losing all your trading capital, failing as a Forex trader, giving up, never to return to Forex trading again, ever again. Keeping a trading journal is the equivalent of an athlete's practice. Utter perfection. Very nice. Okay, so I'm going to leave this episode here then. So in the next video, since we finished up all the keeping a trading journal section, we're going to be carrying on with how to use MetaTrader 4. So thank you all for watching, and I will see you guys in the next video. Goodbye.